Right now, the average American savings account pays 0.59% in interest. At the same time, the average bank net interest margin, the spread between what they pay you and what they charge borrowers, sits at 3.39%. That gap is not a coincidence. It is a business model. So a lot of people made the obvious move. They opened a high-yield savings account. 4%, 4.5%, some paying close to 5%. It felt like the system had finally been beaten, like the smart money had won. But here's the thing. The high-yield account is still a bank account. The bank behind it is running the same playbook as the one you left. They are just offering you a slightly bigger cut of what was already yours. Which raises a question most people never think to ask. If the high-yield account is still a middleman, who is on the other side of that trade, and is there a way to get there directly? That is what this video is about. There is a structural move almost nobody makes, and it has nothing to do with finding a better rate. Every month spent in the wrong account is a month the spread goes to someone else. My name is Alex, and if you have ever felt like your savings are growing, but your actual financial position is not, stay with me through this one, because the account type is not a minor detail, and I'm going to show you exactly how the middleman extracts profit from your deposits without you noticing, and what cutting that relationship off completely actually looks like in practice. Once you understand how this system is built, you will stop measuring your progress by the rate on the label and start asking who is actually keeping the difference. The mechanism behind all of it traces back to one specific structural fact, and it starts the moment your deposit hits the bank. Your bank has a business model. Most people have never looked at it directly. Once you do, the savings account math starts making a different kind of sense. The moment your deposit clears, the bank goes to work, not for you, but with your money. Banks do not hold your cash in a vault with your name on it. They lend it out immediately to other customers, at rates that have nothing to do with what they are paying you. That spread, the difference between what they pay depositors and what they charge borrowers, is the core of how American banking makes money. Currently, the average bank net interest margin sits at 3.39%. That is the profit the bank captures on every dollar you park with them. And it does not matter whether you're in a standard account or a high-yield one. The model is the same, only the crumb size changes. Let me make this concrete with two people. Claire is a 38-year-old teacher in Ohio. She does what most people do, keeps her savings in the same bank she has used since her mid-20s. Her account pays 0.38%. On a $20,000 balance, that is $76 a year, not a month, a year. $76 in exchange for the bank holding her money and lending it to other people at multiples of that rate. Now consider Tom. Tom is a 44-year-old accountant, someone who actually pays attention to this stuff. He read the articles, compared the rates, and moved his savings to a high-yield account paying 4.5%. On the same $20,000, Tom earns roughly $900 a year. He feels like he figured something out. And relative to Claire, he did. But here is where the comfortable story stops. The bank paying Tom 4.5% is doing the exact same thing as Claire's bank. It takes Tom's deposit and lends it to someone buying a car at 7%, or to someone carrying a personal loan at 12%, or to someone revolving a credit card balance at an average of 21% right now. The bank collects the high end of that spread, hands Tom a portion of it, and keeps the rest. Tom is not beating the system. He is participating in it on slightly better terms. Sometimes the math is even more direct than that. Banks regularly take customer deposits and purchase short-term U.S. Treasury Bills, yielding around 3.6 to 3.7% currently. That is the entire transaction. The bank borrows your money at 0.59%, the current national average savings rate, buys a government security at 3.6%, and pockets the difference. No credit risk, no complexity, just a spread on an asset you could have bought yourself. The bank is literally acting as a paid intermediary between you and the U.S. government, and you are the one doing the paying. Now, back to Tom. His 4.5% feels like a real number until you look at what actually lands in his account after tax. Interest from a high-yield savings account is taxed as ordinary income, at both the federal and state level. If Tom lives in a state with meaningful income tax, and most states do, a significant portion of that interest disappears before he ever sees it. In a high tax state like California or New York, he could be handing back more than a quarter of his return immediately. His real after-tax yield is considerably lower than the headline rate. And then there is the rate itself. Tom's 4.5% is not a contract. It is an offer, and the bank can change it at any time without notice. When the Federal Reserve cuts rates, which it does, and will again, banks move their deposit rates down quickly. The high-yield account that attracted Tom last year will quietly reprice, often before he notices, often without a meaningful alert. The number that looked attractive when he opened the account is not the number he will earn indefinitely. It is a variable that the bank controls entirely. So Claire is earning almost nothing. Tom is earning something, paying tax on it, watching the rate drift, and still handing the bulk of the profit to the same institutional middleman he thought he had outmaneuvered. Both of them are inside the same system. The system just gives Tom a better seat. Here is the incentive structure worth understanding. Banks are not designed to maximize your return. They are designed to maximize the spread between your return and theirs. Every dollar they pay you in interest is a dollar of margin they gave up. The high-yield account exists not because banks decided to be more generous, but because competition forced them to share slightly more of the spread to attract deposits. The motivation was never your financial well-being. It was their funding cost. That is not cynicism. It is just how the business works. And once you see it clearly, the obvious question is whether you actually need the bank in the middle at all, or whether there is a way to cut that relationship off entirely and go straight to the source. It turns out there is, and the after-tax math on doing it is closer than most people expect. Here is something most people never stop to consider. The US government has been borrowing money from ordinary Americans for over 2 centuries. You do not need a bank's permission to participate. You never did. So let's pick up where we left off. You now understand what the bank is doing with your deposits, lending them out at 7, 12, 21%, while handing you back less than half of 1%. Daniel moved to a high-yield account and got a bigger crumb. Still a crumb. The question now is whether there is a way to remove the bank from the equation entirely. There is, and it is simpler than most people expect. The mechanism is U.S. Treasury Bills. These are short-term government debt instruments. 4 weeks, 8 weeks, 13 weeks, 26 weeks, up to a year. When you buy one, you are lending money directly to the federal government, and the federal government pays you interest. No bank in the middle. No spread being skimmed. Just you and the government at the same table. Currently, short-term Treasury bills are yielding around 3.5 to 3.7%. On the surface, that looks roughly similar to a high-yield savings account. Here's where it actually gets interesting. Interest earned on Treasury bills is exempt from state and local income taxes. Completely exempt. That is not a loophole or a technicality. It is federal law. And that single fact changes the math considerably depending on where you live. Let me show you what that looks like in practice. Take Marcus, a marketing director living in California. He has $30,000 sitting in a high-yield savings account, earning 4.3%. That earns him about $1,290 a year before taxes. California taxes ordinary income at up to 13.3%, one of the highest state rates in the country. By the time Marcus pays federal and state tax, a meaningful portion of that interest is gone. His real after-tax yield is considerably lower than the number on the account page. Now run the same $30,000 through a Treasury bill, yielding 3.6%. That is $1,080 before tax, slightly less on paper. But Marcus pays 0 California state tax on that interest, only federal. When you run the actual after-tax numbers side by side, the gap between the high-yield account and the Treasury bill closes dramatically, and in many cases, the Treasury bill comes out ahead. In a state like New York, where state income tax runs up to 10.9%, the math tells the same story. The headline yield is not the real yield. What you keep is. And here is the second advantage that rarely gets mentioned. Treasury bills lock in your rate. When you buy a 26-week bill, you know exactly what it will return when it matures. The high yield savings account cannot promise you that. The rate can move the day after you fund it. Banks track the Federal Reserve closely on the way down, and they move faster than most people notice. Treasury bills, by contrast, are a contract. The rate on the day you buy it is the rate you earn. Full stop. Now, the practical question: how do you actually do this? 3 routes, and all of them are straightforward. The first is treasurydirect.gov, the US government's own platform for buying Treasury securities directly. No broker, no fee, no middleman of any kind. The website looks like it was designed in 2004, which frankly, it was. But it works. You create an account, link your bank, and buy bills directly. The second option is through a Treasury ETF, an exchange-traded fund. In your existing brokerage account, SGOV, which is the iShares 0 to 3-month Treasury Bond ETF, currently yields around 3.55% with an expense ratio of just 0.09%. That is effectively nothing. You buy it like a stock, it pays monthly distributions, and the interest still carries the state tax exemption. The third option is a money market fund at your brokerage that holds primarily Treasury securities. Slightly less yield than buying directly, but instant liquidity. The money is available the same day you need it. What about FDIC insurance? It is a fair concern, but consider what FDIC insurance actually is. It is a federal government guarantee that if your bank fails, you will get your money back up to $250,000 per depositor. When you hold Treasury bills, you are lending directly to that same federal government. You are not giving up safety. You are going to a higher source of it. The guarantee behind a Treasury bill is the full faith and credit of the United States. That is the same institution backing the FDIC in the first place. The honest caveat worth naming: if you need your money tomorrow, genuine emergency fund money. A savings account still wins on pure liquidity. Treasury bills have a maturity date, and selling early on the secondary market introduces a small amount of price risk. For your most liquid layer, the high yield account is still a reasonable parking spot. But for everything above that, your medium-term savings, your cash reserves, any money you will not need within the next few weeks, the Treasury bill route is simply a more efficient structure. Same safety, better after-tax return, and a rate that does not quietly disappear on you. Cutting out the middleman solves one problem. But there is a deeper issue that most people optimizing their savings accounts have not confronted yet. Because once you build an efficient cash system, you are still left with the same unresolved question: how much should you actually be accumulating in the first place? And what is the real cost of getting that number wrong? That tension is what leads a lot of financially disciplined people straight into what I call the accumulation trap. Nobody talks about the other side of the savings problem. Everyone worries about saving too little. Almost nobody asks what happens when disciplined savers optimize the wrong thing. So you have done what the last section laid out. You cut out the bank. Your cash is working more efficiently. The middleman is gone. You're earning a real after-tax return on your liquid savings for the first time. That feels like progress, and it is. But here is where something quietly goes wrong for a certain kind of person, the person who is actually good at saving. Think about what happens psychologically once you get your financial system running well. The account grows, the discipline compounds, the number gets bigger. And somewhere along the way, the number stops being a tool and starts being the goal. You do not notice when it happens. It is gradual. One year, you are saving because you have a plan. The next year, you are saving because stopping feels dangerous. The year after that, you are saving because you cannot quite picture what stopping would even look like. This is what I call the accumulation trap, and it is more common than anyone admits. Meet Kevin. Kevin is a 51-year-old civil engineer in the Pacific Northwest. He has been maxing out his 401k, that is his employer retirement account, for 19 consecutive years. He drives a 12-year-old truck. He took exactly one vacation in the last decade. He has $1.2 million saved and a paid-off house. By almost every external measure, Kevin is winning. He is also, quietly, miserable. He tells himself he just needs one more year, then another. The reasoning always sounds sensible. The market might correct. Healthcare costs might spike. Inflation could run hotter than expected. All of those things are true concerns, but they are also infinitely flexible. There will always be a credible reason to work one more year. The goalpost moves because the goalpost was never fixed in the first place. Kevin is not saving towards something anymore. He is saving away from fear. Here is the data point that should make that uncomfortable. Currently, roughly 40 to 50% of Americans retire earlier than they plan, not by choice, but because of a health event, a layoff, or a family obligation that simply could not wait. They did not get the one more year they counted on. They got whatever years they had. Kevin assumes his timeline is negotiable. For a significant portion of people who think exactly the same thing, it is not. And even for those who do get the full timeline, there is a cost that rarely shows up in any retirement calculator. Kevin spent his 50s working full days at a job he stopped enjoying in his mid-40s. He skipped his daughter's soccer seasons because work came first. He kept telling his wife that they would travel when things settled down. Things settled down when he was 63, and his knees had started to argue with him on stairs. The money was there. The window for certain things had quietly closed. This is not an argument against saving. Saving matters enormously, and most people genuinely do not save enough. The point is more specific than that. There is a version of financial discipline that starts as a virtue and slowly becomes a trap, where the savings rate is optimized and the life it was supposed to fund gets indefinitely deferred. The account balance gets more attention than the question the balance was supposed to answer. What is this for and when? Most people who fall into this pattern are not reckless. They are the opposite. They are careful, responsible, and good at saying no. The problem is they got so good at saying no that they forgot to say yes to anything. The financial system rewards accumulation with very visible numbers. It does not send you a statement showing what you did not do with the years you spent building those numbers. The way out starts with one distinction. There is a number in your financial life that represents genuine security, the floor that covers everything essential for as long as you need it. That number is real and worth protecting, but it has a ceiling, and most people in the accumulation trap crossed that ceiling years ago without noticing, because nobody told them the goal had changed. Everything above the floor is not a security question anymore. It is a life question, and answering it requires a completely different framework than the one that got you here, one that starts with asking what the money was actually supposed to be for. That is exactly what the silent tax of time is about. There is a philosopher's question hiding inside a personal finance problem. It goes like this. If money is just stored time, hours you traded for dollars, what does it mean to die with a lot of it left over? That is where the last section left us. Kevin had the floor figured out. He knew what security looked like. He had crossed the line between enough and more than enough years ago. The question that remained was not financial. It was something harder. What is the money actually for? There is a book that takes that question seriously. It is called Die with Zero, written by Bill Perkins, a hedge fund manager and energy trader who spent his career thinking about risk and return. The central argument is not that you should be reckless with money. It is that money is a battery. It stores the life energy you spent earning it, and a battery that never gets used is not a success. It is a waste. Perkins frames this through a case study that is worth sitting with. Imagine a physician who spends 43 years practicing medicine, saving aggressively the entire time. He drives practical cars, takes modest vacations, defers almost everything he wants to do until retirement. He retires at 66 with $2.3 million saved. 2 years later, he has a significant stroke. He spends his remaining years in and out of medical care and passes away at 71, leaving behind most of what he saved, completely unspent, transferred to heirs who are themselves already in their mid-50s. Society looks at that man and sees a successful, responsible professional. Perkins looks at the same picture and sees a failure of optimization, not a moral failure, a mathematical one. The physician traded tens of thousands of hours of his life, his 40s, his 50s, his best years of physical capacity, for a balance he never deployed. In economic terms, he generated enormous value and extracted almost none of it. Here is why this matters beyond one hypothetical person. The data on inheritance timing in America is sobering. Inheritances are most likely to arrive when the recipient is already in their 50s. Think about that for a moment. Your kids receive your money at 52. They already have a mortgage, a career, probably their own retirement savings. The money is welcome, but it is not transformational. It does not change the arc of their lives in the way it might have at 30. The down payment they could not afford at 28. The business they wanted to start at 35 but could not fund. The student debt that shaped every financial decision they made in their 30s. Your money arrives too late to reach any of those moments. Perkins calls the alternative giving with a warm hand instead of a cold one. You give while you are alive, while you can watch it matter, while you can see your son use it to buy his first house, and your daughter use it to take 6 months off, and finally write the book she's been deferring for a decade. The annual gift tax exclusion currently allows you to give up to $19,000 per person per year without any tax consequence. 2 parents giving to 1 child can transfer $38,000 a year, every year, tax-free, starting now. That is real capital delivered at the right time in someone's life, not a number on an estate document that gets processed after a funeral. But the part of die with zero that deserves the most attention is the concept of memory dividends. This is the idea that experiences do not end when they end. When you take a trip at 34, a real trip, an adventure, something that stretches you, you're not just buying 10 days in another country. You're buying 60 years of memories. You tell that story for the rest of your life. You think about it when things get hard. It shows up in conversation, in how you see the world, in who you become. The memory pays a dividend every time you revisit it. And like any investment, the earlier you make it, the longer it compounds. The same experience at 70 might still be meaningful, but the dividend period is shorter, and the physical reality of 70 is simply different from the physical reality of 34. There are things your body can do at 38 that it will negotiate with you about at 63 and refuse entirely at 71. This is not pessimism. It is biology, and ignoring it is not financial prudence. It is just a different kind of risk. So how do you act on any of this without abandoning discipline entirely? Perkins offers a practical framework called time buckets. Instead of a generic bucket list, a document that sits in a drawer and never becomes a decision, you divide your life into 5 to 10-year windows and assign experiences to specific periods. Adventure travel and physically demanding goals go in your 30s and 40s, while your body is still cooperative. Family-centered experiences, the ones that require your kids to still be at an age where they want to spend time with you, go in your 40s and early 50s. That window, by the way, is narrower than most parents realize. Legacy and slower-paced experiences belong in the 60s and beyond. The point is not to schedule every moment of your life. The point is to stop treating time as infinitely flexible when it is not. Every 5-year window has experiences that belong inside it and cannot be fully replicated outside of it. And for those worried about genuinely running out, which is a real fear and a legitimate one, the solution is not to hoard. It is to calculate your actual survival number, what it costs to cover your essential needs through a long life, then transfer that risk to an insurance company through an annuity. You pay a lump sum, they guarantee you a monthly income for life. The fear of running out gets resolved with a contract, not with an ever-growing balance that you never actually spend. Once that floor is in place, every dollar above it changes category. It is no longer security. It is consumption capital. Money that exists to be spent on the experiences, the people, and the moments that make the years between now and that floor actually worth funding. Here's what this video is really about. Banks are not your financial partners. They are businesses built on the spread between what they pay you and what they charge everyone else. The high-yield account feels like a win because it is a better deal than the alternative. It is still someone else's deal. Treasury bills exist. The government will pay you directly. The state tax exemption is real, and the math closes the gap faster than most people expect. The middleman is optional. Saving is a tool. It was always a tool. The moment it becomes the destination, you have already lost something. Time you spent building a number instead of spending it on the life the number was supposed to fund. And experiences compound. The ones you have at 34 pay dividends for 60 years. The ones you wait until 68 to have pay dividends for 12. That is not a small difference. It is the whole game. So here's what to watch for. Look at your cash accounts and ask who is actually keeping the return. Look at your savings rate and ask what it is building toward and when. And look at your calendar and ask whether the experiences that belong in this decade of your life are actually scheduled or still sitting on a list somewhere, waiting for a better time that may never come. One question worth carrying into the next conversation: if the problem is not how much you save, but when and how you deploy it, what does that mean for how you think about investing the money above your survival floor? That tension runs deeper than most people realize, and it is worth exploring. If this reframed how you think about your cash or your time, share it with someone who is still optimizing the wrong number. And if you want to keep pulling on this thread, stick around, because the next question is harder and more interesting than this one.